Global supply chains are moving, and Vietnam has been gradually increasing its integration and role every day. When Nike set up its factory in 1995, it marked the early wave of foreign investment into a newly opening economy. WTO membership soon followed, drawing in more global capital. But it was during Donald Trump's first presidency that momentum truly accelerated. As trade tensions led manufacturers to seek alternatives to China, many began shifting their supply chain strategies, and Vietnam was in the perfect position to capitalize. During Trump's first term, Vietnam saw a total of $143 billion in FDI registrations, which accounted for nearly 22% of all foreign investment in the country since 1988. Vietnam's low production costs, combined with its strategic location next to China, offer a logistical advantage that allows companies to embrace nearshoring while maintaining supply chain efficiency. In addition, Vietnam's proximity to the China Southern Economic Corridor, a region dubbed the Silicon Valley of China, which contributed 20% to China's GDP in 2023, makes it even more attractive for high-tech industries. Major global players like Samsung, LG, and Apple have already shifted parts of their production to Vietnam, sparking a transformation in the country's industrial landscape, evolving from labor-intensive manufacturing to more value-added high-tech sectors. Although short-term uncertainties emerged when Trump began his second term and announced reciprocal tariffs in early April, concerns have gradually subsided. On August 1st, the U.S. finalized its tariff framework, reducing the rate on Vietnamese goods to 20%, down from the previously threatened 46%. This level is only slightly above the 19% applied to regional peers like Thailand, Indonesia, and Malaysia, and remains well below India's 25%. Additionally, a 40% tariff on goods classified as transshipments will now be uniformly applied across all U.S. trading partners. This outcome reinforces the country's competitiveness in global manufacturing. With only a marginal gap in tariff rates, long-standing structural advantages will outweigh the minimal tariff disadvantages. The uniform transshipment tariff also strengthens the appeal for global manufacturers looking to avoid punitive duties while maintaining supply chain efficiency. Positioned next to China, Vietnam offers a strategic base for satellite production, allowing companies to localize supply chains and reduce transshipment risks. We believe the country will continue to stand out as a resilient, reliable manufacturing hub in the evolving global landscape. First, Vietnam's stable political environment stands out. As a one-party nation, the country has maintained a consistently supportive regulatory environment for foreign direct investment and a pro-investment stance across administrations. Next, Vietnam offers competitive labor costs paired with rising productivity. Despite manufacturing wages increasing at a compound annual growth rate of 8.7% over the last 5 years, they remain 20 to 80% lower than those in Thailand, Malaysia, and China. Productivity has improved alongside wages. The CEO of BW Industrials, a joint venture between Becamex, Vietnam's largest listed industrial park developer, and Warburg Pincus, highlighted that after 3 months of training, Vietnamese workers can reach 80% or more of Chinese workers' efficiency, while earning less than 80% of Chinese wages. Additionally, Vietnam's role as a key player in the global supply chain is reinforced by its 17 free trade agreements and its central location in Southeast Asia, enhancing its importance not only in supply chains but also in political matters. Beyond these existing strengths, Vietnam is strengthening its position with the most significant reforms in a decade. To remain competitive, the government is implementing major changes, streamlining bureaucracy through provincial mergers to reduce bureaucracy inefficiencies, accelerating infrastructure upgrades to cut logistics costs, and investing in power security to ensure stable production. The government is also offering targeted incentives for high-tech industries and has launched a free trade zone in Da Nang and Haiphong, aimed at attracting export-driven and advanced manufacturing firms. These developments solidify Vietnam's place as a top destination for manufacturers relocating operations from China. As of 2024, Vietnam is home to 447 industrial parks, with key concentrations in the northern and southern economic regions. The north is emerging as a high-tech hub, attracting investment in electronics, semiconductors, and renewables, further boosted by improved connectivity and the growing port capacity in Haiphong. Meanwhile, the south stands out for its skilled workforce, large consumer market. The operation of Cai Mep Vai, Vietnam's largest deep-sea port, has strengthened the region's competitive edge. These competitive advantages have drawn multi-billion-dollar investments from foreign direct investors to both regions over the past 2 decades. Currently, the occupancy rate in the North's Tier 1 cities stands at 80%, while the South has nearly reached 90%, according to CBRE. With demand continuing to grow, the government is fast-tracking the approval of new industrial parks to meet this potential. For instance, Binh Duong, a major hub for FDI, has a land bank of around 11,000 hectares for IPs, which will grow by nearly 14,000 hectares by 2030. At the same time, infrastructure upgrades are playing a pivotal role in attracting more FDI, addressing one of the key concerns of foreign investors: high logistics costs. In the north, progress on the Vietnam-China Railway project is accelerating, and Haiphong's seaport capacity is set to increase by 40% in 2025, alongside the approval of a pilot program to transform it into a free trade zone. In the south, ambitious plans include the fast-tracked construction of Long Tan International Airport and upgrades to highways and deep seaport networks, reinforcing the region's appeal for future investment. The concerns surrounding Trump's proposed tariffs led to a significant stock price correction for industrial park companies in April. While a partial recovery has been observed, we think there's still considerable upside potential at current levels. The sector's valuation remains appealing, with the current price-to-book ratio below its 2-year historical average. This attractive valuation is further supported by the sector's growth prospects, especially considering the expansion of the land bank, which has not yet been factored into the book value. As a result, we believe now is the time to seize the opportunity to accumulate stocks of industrial park developers, positioning the portfolio to benefit from the country's transformation.